Uh, is my screen visible?
Yes.
Yeah, so the company on which I did work was Asahi India Glass. It is predominantly into glass solutions company. It's in the manufacturing of glass in the primary and semi-manufactured forms. Uh, the segments include automotive glass and float glass. It's a main supplier of glass to the automotive industry with customers such as Maruti Suzuki, Ford, Toyota, Hyundai, etc. Other than that, the company is also into architectural glass categories uh, like Sunshield, Opal, Super Silver, etc. The key management includes Mr. B.M. Labru, who is the chairman, Sanjay Labru, who is the MD and CEO, with Bhupinder Singh Kanwar as COO for different verticals of the business, followed by Shailesh Agarwal as the executive director and the CFO, and Mr. Praful Swaroop as the chief human resource officer. Apart from that, when we look at the shareholding pattern of the company enjoys as of 31st March 22, the latest financial results which the company had uploaded, we can see that the promoters hold 54% stake. Foreign and Indian promoters, the main reason is that there's a joint venture between the Labru family and Maruti Suzuki. Maruti Suzuki is not an Indian company, it's a Japanese based company. So, henceforth, the foreign promoters. Apart from that, there are non-institutional holdings of 3% in the company, with the rest by others, with the majority stake taken by Indian public investors. Apart from that, I have done a DCF valuation for this company as to understand what's the intrinsic value of the company and what the market values it. So the company had a revenue from operations from the year 2018 to 2022, growing at a annual rate of 3.36 percentage, taking a CAGR at as the reference point of reference, because the year 22, the company had seen a 31% increase, which I believe is the reason for revenge buying, which happened after the pandemic ended, and when people started to buy more cars, leading for more demand for the glass industry. I believe that in the next 2 3 years, the company can keep a steady growth rate of at least 3%, keeping in mind the recession at large and the way Indian economy is currently functioning with the interest rates, which may hike in the future. So the assumptions which I've taken for growth rate for revenue is 3.36% for the next 2 years, which I have made a financial model for. Uh, I have taken the cost of goods, including purchase of stock in trade and others as zero point 0.6 and negative 0.2%. Uh, with other expectations for the tax rate remaining on an average the same amount, and employee benefit expenses to increase as and when the company increases its sales with new employees which it hires. So based on that, these were the numbers on which we have which I have come across. So the company has not had any excise duty payments from 2019 to 22. So I expect the company will not have any major expenses in the next 2 years. Hence, due to which I've kept it equal. I believe that the company will not have any attrition rate. The company's employee benefit expenses will also remain the same for the next 2 years. Apart from that, the company has also started to deleverage its balance sheet. The debt equity ratios have started to go lower. So we can expect the company to increase its interest cost payments in order to deleverage itself. Apart from that, we have given an expectation of 34,900 crore and 41,843 crores as our profit after tax for the next 2 years. Taking it ahead in the balance sheet, we have expected the property, plant and equipment to see an increase with the increase in sales which is seen here. So for this increase in sales, we have expected that the company will invest more in its capital assets. Even when you pay attention to the balance sheet, we can see that the company has lot of capital work in progress in the form of plant property and equipment, which will take a year or two to complete. So that is why we have I can see that I thought that there could be an increase in the plant property equipment. Apart from that, we have I have taken cash and cash equivalents as 4,100 with an assumption that it will grow on the same rate on an average, like in the way our the sales of the company has increased. Um, the same way we have taken, I have expected that the total assets will reach 4.3 lakh crores, and for 23 and for 22, 24 it will be 4.61 lakh crores. We have expected that the equity share capital will be same at 2431 crores lakhs. Uh, and as I mentioned, that the company will is trying to reduce its leverage. So I expect that there will be no additional borrowings that the company will do, but the company will keep on repaying. But we can't, you can't be certain as to what by what levels will the company lower its debt. So I have kept it constant these years. Apart from that, trade payables. The company has trade payables of 6150 for 23 and 6253 for 24. We've taken an assumption that the company's accounts payable will also increase with the increase in sales. So that has led to a deficit of 25,000 and 32,000 for the next forecasted years, as you can't have a tallied balance sheet when you forecast. The WACC calculations for the valuation have been a 5.8% WACC, as the company's post-tax debt is 9.2% with its cost of equity of 4.17%. Taking into consideration from April 18 to March 22, the data has been taken, and we have the DCF program tells us that the company is undervalued by the market based on whatever assumptions were taken right now, and the company still has further growth potential uh, in order to reach 690 rupees as of in the next upcoming 2 years, with the current market price as on 14th Feb when I did this valuation of 509.15 rupees.
Right. Is is it the end, or will you go to the next sheets? I mean, relative valuation and conclusion, or
Yeah. So when I saw the companies, this data has been taken from fixed income. So looking at the way the company has grown over the years, even though we see that RO EBIT margins or the margins of the company in comparison to its peers have not been up to levels that investors are more likely happy with. But the company, on an average, has seen an increase in its profitability margins over the years. As I mentioned, the company has is quite undervalued by the market with a PE of 29.45, whereas its peers are quite overvalued. Um, the PB ratio is also 6.23, which is a fairly decent ratio. Then the debt equity ratio, if you observe the debt equity ratio for the company over the past few years, you can see that the debt equity ratio has started to lower, even though its peers have a 0.02 and a 0.23 as debt equity ratio. But when you look at the balance sheet and when you look at the health of the company, surely Asahi India has is better, is well equipped and better positioned in its in the market right now. The fact remains that the company has a very low interest coverage ratio, but this fact can be ascertained also by the debt equity structure which the company has. Uh, the company's the company needs to lower its debt for which leads to a lower in the interest cost, which will help the company to have better interest coverage ratios in the future. And also the operating efficiencies has been fairly decent of the organization, better than its peers for some in some places. And the growth even looking at the growth percentages of the company, we can see that the company has performed better than its peers.
Is the growth percentage for, I mean, the for, I mean, is it 1 year or do you have 5 year or 3 year growth as well?
I've take
I mean,
currently I when this the photo which I've taken is only for a year, but I've
okay,
also looked at the years 2 3 years prior to this. Henceforth, I feel that it's a good company to invest right now.
great, great. Yeah, that's a it's a very clear and very precise presentation. Very good on presenting this way. I wanted to know a bit about the product. Have you gone through, I mean, their products? What my first question would be, what I know about Asahi is that they are into glass manufacturing for vehicles. Are they
Yeah,
also getting into solar? I mean, for solar cells, I mean, these solar panels that you have,
yeah,
you also have a
yeah.
thick glass, which Borosil Renewables are into. So I'm curious whether this company is also getting into it, and have they planned any capex for that?
Oh, yeah, the company, as much as I remember, in the balance sheet, there was in the annual reports there was a mention of solar products as well. But
Mhm.
I've not done a research on that aspect, whether how much of the capital expenditure which the company has planned will be for the solar projects. But definitely, when you look at the website as well, we get to know that the company has some plans for the solar manufacturing part as well.
Got it. Did you go through the con call by any chance?
Um, no, I was unable to come across the con call for the company.
Okay, a lot of your assumptions probably would get, I mean, resolved in the con call. But anyways, that's something I was not also expecting from you. In fact, the company doesn't even do con call. Okay, interesting. The company doesn't do con call. That's what I saw. Okay, that's very good. The next thing is I wanted to understand, or did you deep dive into the process of glass manufacturing? What are the steps? What are the key raw material? Do they have any dependency on certain commodities? Do you have any background of it, or did you, I mean, look that up?
No, unfortunately, that I didn't pay more attention towards. I I thought of this project as if I am investing. If I invest
Mhm.
today, then what are the things which I will pay more attention towards? Definitely, this is a key aspect towards investing, and I'll have to read about this
No
shortly.
problem. No problem. No
I've not
problem.
done that research as of now.
Yeah. The next thing that I wanted to understand from you was the management quality. I mean, how
Yeah.
much of the cash flow from operation is getting converted to EBITDA? Do you have, I mean, have you done some sort of forensics? Like, is the company, I mean, generating cash? Do you have those cash flow metrics?
Yeah. So
Could you open? So basically, what is the free cash flow and all of those things?
yeah, yeah. Just give me a second. Yeah. So the company has, as we can see here, The
Hmm.
company's cash flow from operations has been positive for the past 5 years, with the company also paying off uh, a lot of debt, as I mentioned. In the past, in the more recent years, the company has had a huge cash outflow over the past 3 years,
Hmm.
and as a net cash inflow of 28.06, which is which can also be seen in the cash and cash equivalents of the organization.
Okay. So what I'm curious about is how much of EBITDA is getting converted into cash flow. Let me just also check it up. Give me a second. Other income. Operating profit is sorry, for this December quarter, it's 188. And, oh, sorry, I need to check for the entire year. Okay, yeah, these are. I mean, there are some forensic metrics. Probably as you get along with the project, I mean,
Mm-hmm.
with the group, there are certain things we are very curious about looking.
Okay.
One thing that we try to see is whether the promoter is honest, and one good
Yeah.
way to see whether the promoter is honest is if the business is actually generating cash, right?
Yeah.
So
Yeah.
basically, your cash flow from operation divided by EBITDA should be a good number. I mean, it should be above 0.5 or 0.4.
Okay.
And
Yeah.
also, the second thing that we want to see is what is the amount of free cash flow that is generated. Is the business
Yeah.
generating
Yeah.
cash, right? Because
Yeah.
free cash flow is a very good metric. I think you have calculated free cash flow somewhere, isn't it, in your
Uh,
DCF sheet?
yeah. In my DCF sheet, I've calculated for this year. So for this year, the company has a free cash flow of 9447.
Crore. Okay. And you expect it to go up quite significantly in the next year.
Yes, this the reason the company has, I find, is because of the purchase of assets from 11,000 to 22,000, with
Hmm.
an increase in sales. So that is the reason why the company's free cash flows will increase. But definitely, this number is can change in the upcoming years if the company decides to use its existing assets and not go
Okay.
for any new purchases.
Just a second. Let me calculate what is the free cash flow. 1 second. So for you, it's coming as. So what is FCFF? I'm sorry, I'm not from finance background. Many times I'm
FCFF is free cash flows to the firm.
sorry. Free cash flow too.
Free cash flow to the firm.
Okay. So basically, you subtract cash flow from operating activity minus your
Uh, you
capex done.
Yeah, you add a bit, you take NOPAT, that is the non-operating
Mhm.
profit after tax. You add back any non-cash expenses like depreciation, and then you subtract for purchase of assets and change in working capital to get your free cash flows to the firm.
Right. Okay. So for me, it's coming a bit different, but maybe I have some calculation error, and I'm also seeing it from Screener. So lots of
Okay.
times
Yeah.
Screener gives
Yeah.
wrong
Yeah.
information with respect
Yeah.
to
That's true.
this number. But cash flow from operation in March 22 is 586 crore. Um, that's the number that they have from the cash flow statement.
Yeah.
I think
Yeah.
that's from the annual report itself.
Yes. Yes.
For you, what is the cash flow from operation? Where is it? Could you show me?
I have taken EBIT into 1 minus tax, that is a NOPAT. I've taken it from the core operations perspective. If the company has core, rather than using net profit or cash flows from operations, I've taken EBIT
Hmm.
as a source of measure for
Got
the
it. Got
company.
it. Yeah, that's also a good approach. I mean, going it on the other side. Great. Now, I think more or less your presentation was very good. I got a clear idea. We will polish upon the parts of forensics because that is
Yeah.
also very crucial. But the way you have presented it is super.
Thank
I
you.
actually like it. Uh, so as a next step, maybe I will share this video with my co-founder. Let him check through it, and he'll also give some
Okay.
feedback and some questions. But
Okay.
in general, I mean, I'm more or less positive to onboard you. Let me know when you can
Thank you.
start working, and I'll send you all the documentation. Just a simple NDA. Just sign it, and also send me your bank account details so that I can
Okay.
credit
Sure.
your salary. Yeah.
Sure. Sure. That will be.
Uh, Great. Tanvi, another thing is we have presentations, or sorry, we have a stand up at 7 p.m. every day. right?
Okay.
Uh,
Okay.
so hopefully